Hey guys, what's up? I'm Erin and welcome back to the channel. Watching your accounts dwindle in value is painful. Literally, losing money activates the same areas of the brain that cite pain and fear. You put your money into the market with the goal of creating a more prosperous future for yourself and your family, only to watch it do the exact opposite. It's no wonder that all those headlines that scream bear market are so frightening. From a strictly technical and dictionary-like perspective, a bear market occurs when a broad market index falls by 20% or more. But that's not really what a bear market is. A bear market is watching the stock market fall into the red. It's listening to all those talking heads on the news warn you of just how bad it might be this time around. It's having hundreds of articles and advertisements hit you with negative news each and every single day. It's worrying about meeting your personal financial goals as you watch your hard-earned money evaporate. It's that stress and inner panic you feel. When a bear market's declared, it's like economists are finally sounding the alarm when so many people have already been in a state of stress waiting for them to sound the alarm. It's like people think, oh my goodness, they finally said it. I knew they were going to, but now that they actually did, now I feel worse. What are we supposed to do? Bear markets feel scary, not just for the reasons I listed, but because they feel like they're not the norm. The stock market's supposed to go up, right? Every single year we're supposed to get our 10%. Heck, some years we get 20%. We're supposed to enjoy living in prosperity, right? Well, the fact of the matter is, that's a complete and utter lie. Bear markets are more common than most people realize. Since 1929, we have been in a bear market 24% of the time. That's 1/4 of the entire time. That's a pretty significant amount of time to spend in a bear market. For instance, if you experience chronic pain for 3 months out of the year, a fourth of the year, you might deem that a fairly significant amount of time, or 6 hours out of every single day. That wouldn't simply be deemed a rare occurrence. But of course, bear markets don't show up in predictable intervals. Rather, they show up in a more irregular fashion. But that doesn't make them uncommon. And just because they are common, maybe instead of thinking about bear markets like this, we could start to think about them like this. And of course, there's the simple fact that bull markets are simply more enjoyable. When everything is going well, when the markets are hitting new highs, there's this overwhelming sense of abundance. Bear markets are just the opposite. Everything around you is falling and it feels like there's nothing you can do about it. Humans have what's called a negative bias, where negative emotions are felt more profoundly than positive emotions. So we feel those bear markets more acutely. And if you're fairly new to investing, for example, say you've only been investing for the past decade or so, you're probably only familiar with the glorious bull market. Because ever since 2009, the market's been in a relatively calm state. There hasn't been any prolonged market downturns. There hasn't really been recessions to speak of. In fact, it's been quite a wonderful time to be an investor. For many, this is perhaps the first time that they're experiencing a bear market, and it can be quite frightening. If all you've ever known is a thriving bull market, a bear can seem like a rare aberration. But keep in mind that bear markets happen, and they happen more frequently than most investors realize. Long term, the market goes up, but long term often means longer than most investors realize as well. In fact, over any given 10-year period in stock market history, the market has been down only 6% of the time. Over any given 20-year period, the market has never had a negative return. So history does show us that over the long term, the market does go up. You just have to be willing to wait it out. So we currently find ourselves in a bear market and potentially a recession, although we can't technically say recession yet. But it is worth noting, since 1945 to present day, our economy has been in a recession 14% of the time. While that's not as common as a bear market, it's not completely unheard of either. The longest recession was the Great Recession, from December of 2007 to June of 2009, lasting a total of 19 months. The shortest recession lasted just 2 months when the pandemic struck, starting in February 2020. Most recessions last 6 to 8 months. Rarely do they go longer than a year. Since World War II, we've averaged a recession every 5.5 years. So maybe from that perspective, maybe we're due for a recession and maybe a little bit of economic contraction. Because that recession that happened in 2020 that lasted 2 months was really more of a hiccup than anything else. Our last real recession wrapped up in 2009. That's 13 years ago. So maybe it's time we get to it so we can get through it. Yes, recessions are worse than a bear market. Not only do you have the negative stock market, you have rising interest rates, increasing job losses, and other economic turmoil that over time starts to wear on people's physical and mental health. But perhaps you can find some solace in knowing that most recessions are brief in nature. And if history has anything to say about it, our stock market and our economy will recover just fine given enough time. Our current bear market began on January 3rd, but it wasn't until June that it was officially declared a bear market. That's quite the time lag. Now, of course, certain metrics have to be met. Indices have to fall by 20% in order for it to officially be declared a bear market. But whether or not it was declared, for the past several months, we've all felt like we were living in a bear market. And recessions follow a similar pattern. According to the Economic Research Bureau, recessions are declared anywhere from 4 to 21 months after they happen. There's no fixed timing rule. We wait long enough so the existence of a peak or a trough is not in doubt, and until we can assign an accurate peak or trough date. Sure, once a second sequential quarter of negative GDP growth comes out, we can officially say that we are in a recession. But we won't have more concrete details about a recession until later, perhaps several months later, because it takes time for all of this different economic data to trickle in. Our personal perspectives can tell us that we're living in a recession right now. We don't have to wait for an official board to declare it so, because by the time they actually make their declaration, we've already been living in the thick of it. Perhaps we're near the end of it by the time they make their announcement. These economic commissions have some lag time because they're waiting to gather so much data. And keep in mind that them making the statement that we're in a recession or we're not in a recession doesn't make the situation better or worse. Yes, people immediately do react to their statements because that's how economies work. We react to news as it comes out, but they are simply commenting on the situation that we're currently living in or our current historical situation. Their statement of, yes, we're in a recession, didn't cause the recession. We've already been living in it by the time they make that statement. And based on the frequency with which bear markets occur, and to some extent even recessions, the possibility of a downturn is always present. So no matter what the circumstances, you should always be prepared. And if you believe in the efficient market hypothesis, a theory about the stock market where all present and expected information is already priced into stocks, you might be thinking that a potential recession is already priced into our present day stock market. And that is exactly what Jeremy Siegel, a prominent finance professor at Wharton, has suggested. I actually think the market is already discounting a recession in 2023. It's being priced at that level today. I think we're pricing in a mild recession. I'm not saying how severe the recession actually will be. I've always had the viewpoint that the market reacts and overreacts to current and expected events. This goes for both positive and negative events. When everything is booming, that stock market surges to higher levels than are actually justifiable. When times are hard and a recession is potentially looming, the stock market dives to lower levels than are truly justifiable. Tough times don't last, and maybe those words aren't helpful if you're in a situation where you're suffering. I know there's not a lot of good news out there about the economy or about the stock market right now, but it does help to know that these events happen, and they happen more frequently than many investors realize. By the time the next stock market boom hits, and it will, we will be packing away these turbulent times into our distant memories, thinking that the good times will go on forever. We've been blessed with a wonderful stock market over the past decade. Now is not the time to get spooked, especially if this is your first bear market. Downturns are an inevitable part of investing. The market will recover. It always has. If we find ourselves in a recession, we will work our way out. We have always recovered in the past. There's no reason to expect that we won't in the future. Those that stay invested for the long term, those are the people who are handsomely rewarded. So as always, stay the course. Let me know your comments and thoughts down below. I always appreciate what you guys have to say. That's gonna do it for me on this one. I post new videos every single week. If you got anything at all out of it, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you guys soon. Bye.